The structural foundation of the global financial system is currently undergoing a stress test that most market participants fundamentally misunderstand, and JPMorgan's recent institutional research confirming the Federal Reserve will not cut rates in 2026 represents far more than a forecast revision. It marks the moment when the world's largest financial institutions stop pretending that monetary policy retains the flexibility that defined the post-2008 era and began preparing clients for a fundamentally different environment. This acknowledgement signals that we have crossed a threshold in the debt supercycle that began in the early 1980s, where the mathematics of compound interest and leverage are now dictating outcomes rather than responding to policy interventions. What makes this particular juncture so consequential extends beyond the simple fact that interest rates will remain elevated. The entire architecture of modern finance was constructed on the assumption that central banks retained unlimited capacity to intervene during periods of stress, providing a backstop that allowed risk-taking to expand far beyond what underlying economic fundamentals could support. That assumption is now being tested in real time, and the early evidence suggests it was always more theological than empirical. The Federal Reserve finds itself trapped between the Scylla of persistent inflation and the Charybdis of a financial system that cannot function without cheap liquidity, with no clean path forward that avoids significant wealth destruction. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The scale of what we are examining extends far beyond typical market corrections or even severe bear markets. We are witnessing the unwinding of a 40-year debt supercycle where every major economy used declining interest rates to substitute cheap credit for genuine productivity growth, wage increases, and real capital formation. When rates fell from the double-digit levels of the early 1980s to effectively zero by 2008, governments, corporations, and households systematically increased their leverage, creating a financial structure that became entirely dependent on the assumption that cheap money would remain available indefinitely. The mathematics of this arrangement are straightforward but brutal. When interest rates rise from near 0 to 5% or higher, the carrying cost of existing debt increases proportionally, but the capacity to service that debt does not. This dynamic creates what systemic risk analysts call the doom loop between fiscal and monetary policy. The U.S. federal debt now exceeds levels historically associated with wartime, with annual deficits running at levels that would have been considered emergency measures in previous decades. As this debt rolls over at higher interest rates, an ever larger share of tax revenue must be devoted to debt service, crowding out spending on infrastructure, defense, and social programs, while simultaneously requiring additional borrowing just to pay the interest on existing obligations. The Federal Reserve cannot cut rates meaningfully without risking a resurgence of inflation, yet maintaining high rates accelerates the fiscal spiral that undermines confidence in the currency and the sovereign debt that anchors the entire global system. Historical precedent provides clear guidance on how these dynamics resolve, though the modern financial system has evolved in ways that make direct comparisons imperfect. The most instructive parallel combines elements of the 1970s stagflation, the 1987 market crash, and the 1994 bond market massacre. In the 1970s, the Federal Reserve under Arthur Burns repeatedly attempted to ease policy in response to economic weakness, only to discover that each easing episode reignited inflation and forced even more aggressive tightening later. The result was a decade of wealth destruction through inflation, negative real returns on bonds, and equity markets that went nowhere in nominal terms while losing more than half their value in real purchasing power. What made the 1970s particularly devastating was the absence of safe havens, Bonds lost money as inflation and rates rose, stocks lost money as profit margins compressed and valuations collapsed, and real estate provided some protection but required leverage that became increasingly expensive and difficult to obtain. Cash lost purchasing power at double-digit annual rates. The broader population, holding conventional portfolios of stocks and bonds in pension funds and retirement accounts, watched decades of savings evaporate not through a single dramatic crash, but through a grinding erosion that felt almost imperceptible year to year until the cumulative damage became undeniable. The 1987 crash offers a different lesson about the fragility of modern financial plumbing. Markets had become increasingly dependent on portfolio insurance strategies that were essentially automated selling programs designed to limit downside risk. When volatility spiked, these programs triggered simultaneously, creating a cascading liquidation that overwhelmed market makers and caused a 23% single-day decline. The crash was structural rather than fundamental, caused not by deteriorating economic conditions, but by the architecture of the market itself. The Federal Reserve responded with immediate liquidity provision and rate cuts, stabilizing the system within weeks, but that playbook only worked because inflation was already declining, and the Fed had room to ease aggressively without consequences. We do not have that luxury today. The growth of passive investing, algorithmic trading, and leveraged exchange-traded funds has created a market structure where price discovery is increasingly divorced from fundamental analysis and where relatively small disruptions can trigger mechanical selling that feeds on itself. Over the last decade, trillions of dollars have flowed into passive index funds that buy stocks regardless of valuation, creating a self-reinforcing loop where inflows drive prices higher and attract more inflows. This mechanism works in reverse during stress periods, where indiscriminate selling by passive funds can exacerbate downward volatility in markets that have become thinner and more algorithmic than in previous cycles. The 1994 bond market crash is perhaps the most relevant historical parallel because it was triggered by exactly the dynamic we face today: a Federal Reserve that had kept rates too low for too long and was forced to tighten more aggressively than markets anticipated. Bond prices collapsed, mortgage-backed securities lost value rapidly, and leveraged players faced catastrophic losses. The episode was contained relatively quickly because the economy was strong enough to absorb higher rates. Inflation remained moderate, and the Fed could signal that tightening would be temporary. None of those conditions apply today, where the economy is already showing signs of strain under current rate levels. Inflation remains elevated and sticky, and the Fed's own projections suggest that rates will need to remain higher for longer, even in optimistic scenarios. The commercial real estate sector provides a clear microcosm of these broader systemic pressures. Trillions of dollars in commercial real estate loans are maturing in this high-rate environment, having been originated when rates were near zero. Property owners must now refinance at rates that are double or triple their original terms, while simultaneously dealing with vacancy rates that have structurally shifted due to changes in work patterns and consumer behavior. The mathematics simply do not work. The equity in these properties has effectively been wiped out, but the losses have not yet been fully recognized on bank balance sheets due to extend and pretend policies that allow institutions to delay marking assets to market. However, keeping rates high through 2026 removes any hope of a rescue through policy easing, forcing the recognition of losses that will impair bank capital and restrict credit to the broader economy. Regional and mid-sized banks face particular vulnerability because their asset portfolios are concentrated in exactly the sectors most sensitive to interest rate changes. Commercial real estate, long-duration securities purchased during the zero-rate era, and loans to businesses that assumed cheap refinancing would always be available. Many of these institutions are already sitting on unrealized losses that exceed their capital buffers, but accounting conventions allow them to maintain the fiction of solvency as long as they declare the intention and ability to hold assets to maturity. When confidence erodes or deposit flight accelerates, however, the need to realize losses exposes how much wealth was already destroyed. It simply had not yet been recognized. The residential housing market presents a different but equally intractable problem. Home prices remain elevated relative to incomes, supported by a shortage of supply and by existing homeowners who are locked into low-rate mortgages and have no economic incentive to sell. This creates an illusion of stability built on stasis rather than health. Transaction volumes have collapsed, new household formation is being delayed or abandoned, and the wealth effect that drove consumer spending for 2 decades is reversing as homeowners realize their equity is trapped in an asset they cannot sell without significantly downgrading their lifestyle. When this dynamic eventually breaks, either through forced selling due to economic distress or through demographic shifts that increase supply, the adjustment will be rapid and severe, because there are no marginal buyers willing to step in at current prices and current financing costs. Consumer resilience, which has been the bulwark against recession, is being funded by a drawdown of pandemic-era savings and rapid expansion of credit card debt. Delinquency rates on credit cards and auto loans are rising to levels not seen since the Great Financial Crisis, and this is occurring while unemployment remains relatively low. The structural squeeze of inflation on the cost of living, combined with the high cost of servicing debt, has exhausted the consumer's capacity to spend beyond necessities. When consumer spending contracts, corporate earnings decline, layoffs begin, and credit delinquencies transform into defaults, creating the feedback loop that transforms a slowdown into a contraction. The equity market remains perhaps the most overvalued relative to underlying economic reality. Stock prices continue to reflect assumptions that earnings will grow indefinitely, that profit margins will remain at historically elevated levels, and that valuations can stay inflated even as the risk-free rate rises substantially. All 3 assumptions are being challenged simultaneously. Earnings face pressure from rising input costs, wage inflation, and weakening demand. Profit margins are compressing as companies lose pricing power and confront higher financing costs. Valuations are beginning to adjust downward, but remain well above historical averages when measured against metrics like the cyclically adjusted price-earnings ratio or market capitalization relative to gross domestic product. The gap between current prices and what would be considered fair value in a normalized interest rate environment is measured in trillions of dollars, and that gap will close through some combination of falling prices and time. The global dimension of this crisis cannot be overstated because the United States exports its monetary policy to the world through the dollar's reserve currency status. When the Federal Reserve keeps rates high, it strengthens the dollar and extracts capital from emerging markets and other developed economies. Countries with significant dollar-denominated debt face a devastating combination of higher refinancing costs and weaker local currencies that make those costs even more burdensome in domestic terms. This forces foreign central banks to maintain their own rates at punitive levels to defend their currencies, deepening domestic recessions and creating the conditions for sovereign debt crises in countries that seemed stable just years ago. We are also witnessing the transition from a globalized world that kept inflation dormant despite massive monetary expansion to a fragmented world of competing blocks where supply chains are being duplicated for security reasons, trade barriers are rising, and resources are being weaponized. This structural shift toward deglobalization is inherently inflationary and inefficient, creating a floor under prices that prevents central banks from returning to the ultra-low rate policies that defined the previous decade. The peace dividend that allowed central banks to experiment with unconventional policies has been spent, and we are now paying what might be called the conflict tax of a more dangerous and fragmented world. Most market participants miss these dynamics because they are conditioned to think in terms of discrete events rather than processes. They wait for a catalyst, a specific trigger that will cause markets to crash, and when no obvious catalyst appears, they assume the system is stable. This represents a fundamental misunderstanding of how complex systems fail. Large-scale collapses are not caused by single events, but by the accumulation of stresses that eventually exceed the system's capacity to absorb them. The trigger, when it comes, is often something minor and unpredictable: a failed auction of government debt, the bankruptcy of a mid-sized financial institution, or a technical glitch in a critical market. The underlying fragility, however, was built up over years or decades of policy choices that prioritized short-term stability over long-term resilience. This cycle is accelerating faster than previous ones because the system is more interconnected and more leveraged than at any point in history. Information moves instantaneously, capital flows across borders in milliseconds, and risk is distributed through derivatives and structured products in ways that obscure rather than eliminate it. When stress appears in one part of the system, it propagates immediately to others, and the feedback loops are both faster and more intense than in previous eras. The 2008 crisis took months to fully unfold, from the initial subprime mortgage defaults to the collapse of major institutions. The next crisis will likely unfold in weeks or days once critical thresholds are breached, because the mechanisms that might slow or contain the damage have been eroded by years of financial engineering and regulatory arbitrage. For ordinary people, the impact will manifest in ways that feel sudden, even though they were years in the making. Retirement accounts that seemed secure will lose 20, 30, or 40% of their value in a matter of months. Home equity that represented decades of savings will evaporate as housing prices adjust to reflect actual affordability rather than speculative momentum. Jobs that seemed stable will disappear as companies that survived on cheap credit discover they cannot operate profitably in a higher rate environment. Government services will be cut as tax revenues decline and interest payments consume larger shares of budgets, while the social safety net will be tested in ways it has not been since the Great Depression. The common objection to this analysis is that central banks have always found ways to prevent catastrophic outcomes, that policymakers will do whatever it takes to stabilize markets and support the economy. This objection reflects a fundamental misunderstanding of the constraints under which central banks now operate. The Federal Reserve's balance sheet is already bloated with trillions in assets acquired during previous interventions, and expanding it further would risk undermining confidence in the currency itself. Inflation remains the binding constraint that prevents aggressive easing, and there is no technical solution that allows the Fed to simultaneously control inflation, support asset prices, and maintain financial stability. Something must give, and the path of least political resistance is to allow asset prices to fall while protecting the purchasing power of the currency, which means that wealth held in financial assets will bear the brunt of the adjustment. Fiscal policy faces similar constraints. Government debt levels are already at peacetime records, and political appetite for further stimulus is limited by concerns about inflation and by growing recognition that previous stimulus programs largely benefited asset owners rather than the broader population. The deficit is structural rather than cyclical, driven by demographics, entitlement programs, and interest payments that will only increase as debt is refinanced at higher rates. There is no realistic scenario where governments can borrow and spend their way out of this situation without triggering either inflation or a sovereign debt crisis. What we are witnessing is the convergence of multiple unsustainable trends that were set in motion decades ago and are now reaching their mathematical conclusion. The debt supercycle that began in the 1980s is ending, not because policymakers have chosen to end it, but because the arithmetic no longer works. The financialization of the economy that accelerated after 2008 is reversing not because of regulatory reform, but because the returns to financial engineering have turned negative. Each of these trends reinforces the others, creating dynamics where the system becomes less stable, even as policymakers work harder to maintain the illusion of control. JPMorgan's confirmation that the Federal Reserve will not cut rates in 2026 is significant because it represents institutional acknowledgement that we have crossed a threshold from which there is no easy return. The largest and most sophisticated financial institutions in the world are no longer planning for a return to the pre-2022 environment of low rates and abundant liquidity. They are positioning for a fundamentally different world where capital is scarce, returns are lower, and risk is repriced to reflect actual uncertainty rather than central bank guarantees. This repositioning will accelerate as other institutions reach similar conclusions, and the collective weight of that repositioning will itself become a driver of the outcomes we are describing. The transition we are entering will be characterized not by a single dramatic crash, but by a series of rolling crises that unfold across different markets, sectors, and geographies over a period of years. Some assets will collapse quickly while others decline slowly. Some regions will experience acute distress, while others face chronic stagnation. The heterogeneity of outcomes will make it difficult for most people to recognize the broader pattern, and the lack of a clear narrative or obvious villain will fuel political extremism and social instability. This is how large-scale wealth destruction typically occurs, not through a single catastrophic event, but through a grinding process that leaves most people poorer, more anxious, and less secure, even if they cannot articulate exactly what went wrong. The real crash timeline is not measured in days or weeks, but in quarters and years, a slow-motion unraveling of the financial architecture that has defined the modern economy. It has already begun in sectors that most people do not watch closely: commercial real estate, high-yield credit, cryptocurrency, and speculative technology stocks. It will spread to more visible and widely held assets as the mathematics of higher rates work their way through the system and as the reality of persistently tight monetary policy becomes undeniable. By the time it reaches the core holdings of retirement accounts and institutional portfolios, the damage will already be substantial, and the options for mitigation will be severely limited. Understanding this process is not about predicting exact dates or prices, but about recognizing the structural forces at work and the mathematical inevitability of their resolution. Systems built on unsustainable foundations eventually fail, not because of bad luck or poor management, but because the underlying dynamics make failure the only possible outcome. We are observing one of those failures unfold in real time, and the fact that it is happening slowly and unevenly does not make it any less consequential or any less certain. The wealth destruction we are entering will be measured not in billions but in trillions, not in percentage points, but in the restructuring of entire economies and the reordering of social and political arrangements that have been stable for generations. This is not speculation, but simple observation of what happens when mathematical realities collide with political and social systems that are unprepared to accept them.